Hello, I am Cem Oze and welcome to my channel. This content is compiled from the ARK Invest report and is for informational purposes only and not investment advice. The Bitcoin market is at a critical juncture in the third quarter of 2025. On one side, there is growth potential with peak institutional demand and strong fundamental data. On the other side, there is a serious volatility risk emerging on the horizon that requires caution. ARK Invest's latest report clearly highlights this contradiction. Positioned for growth, ready for volatility. While the basic data clearly indicate a bull market, why does cycle timing require caution? This quarter, institutional assets, namely corporate treasuries, DT, and ETFs, hold 712.2% of the total Bitcoin supply at a record level. Despite this massive interest, why is the market preparing for a surge that could explode at any moment? The answers lie hidden in on-chain data and historical cycles. In this video, we will take an in-depth look at 5 key findings from ARK Invest's report. These 5 points summarize the most important dynamics that will determine Bitcoin's trajectory in the coming months. 1. Institutional demand peaks. ETFs and corporate treasuries are accumulating Bitcoin at an unprecedented rate. 2. On-chain data is strong. The market is far from the irrational exuberance levels seen at previous peaks, and fundamentals are solid. 3. Volatility warning. Record supply concentration around price increases the potential for sudden and sharp fluctuations. 4. Nearing the cyclical peak. According to historical halving cycles, we may be in the final stages of the current bull market. And 5. Macroeconomic wins. Despite a weakening labor market, productivity growth potential could support economic expansion. Let's now examine each of these points individually. Institutional adaptation plays the biggest role in legitimizing Bitcoin as an asset class. The figures we see this quarter are the clearest evidence of how permanent and strong this adaptation has become. US spot Bitcoin ETFs have broken a new record this quarter, reaching a massive amount of 1.3 million Bitcoins, which accounts for 66% of the total supply. Historically, we observe that each new record in ETF holdings has been followed by a price record. Alongside this, publicly traded companies' digital asset treasuries, DATs, also did not stay idle. They increased their Bitcoin holdings by 40% within 2025, reaching 1.1 million BTC. This accounts for 5.6% of the total supply. This corporate appetite whispers that Bitcoin is a financial revolution. However, data from the depths of the blockchain suggests that this revolution could be tumultuous. When we look beyond price movements and examine the blockchain itself, we see that the market is based on solid fundamentals rather than a speculative bubble. These data are our most reliable barometer for measuring market health. Bitcoin closed this quarter at 114,065. This level is above the short-term holder, STH, cost basis of 111,933, which indicates the cost for new investors entering the market. This level represents the average cost for investors who have entered the market in recent months. Staying above this level is a psychological indicator that new investors are in profit and that panic selling pressure is low. More importantly, we can clearly see with the AV/V ratio that the market is not at an irrational exuberance level. This ratio, currently at 0.36, is far from the 0.10 level it reached during past bull peaks. In other words, there is still room for growth. Derivative markets tell a similar story. Funding rates and futures premiums are well below the previous cycle peaks, confirming that there is no excessive speculative buildup. So, despite this healthy picture, what risks are looming on the horizon? The answer lies hidden in supply concentration. Price stability is important for every investor. However, ARK's report highlights a significant metric that could threaten this stability. Supply concentration. Supply concentration, which is the percentage of coins changing hands within a 15% range of the current price, reached 30% this quarter. This is the highest level observed since October 2024 and is generally considered a leading indicator of increasing volatility. So, what does this mean? We can compare it to traffic congestion on a highway. When a large number of cars or investors are traveling at the same price and very close to each other, even the slightest braking or acceleration can trigger a chain reaction. In other words, a small price movement can trigger a large wave of selling or buying, leading to sudden and sharp fluctuations. This high supply density resembles a powder keg. The historical cycle analysis we will examine in the next section suggests that it could be like a fuse burning next to this keg. One of the most reliable historical models to understand Bitcoin's price movements is the halving cycle, which occurs every 4 years. So, where are we in the current cycle? Looking at the past two cycles, we see that Bitcoin tends to peak approximately 530 days or roughly 18 months after a halving event. The last halving occurred in April 2024. As of the publication date of this report, this means about 18 months or 530 days have passed since the event. According to the historical model, this suggests we may be approaching the final stages of the current bull market, increasing the risk of a cyclical peak in the coming months. Alongside all these Bitcoin-specific dynamics, of course, the overall economic climate also plays a critical role. The performance of risky assets like Bitcoin is directly influenced by global macroeconomic conditions and central bank policies. There are conflicting signals in this regard. On one hand, the US labor market shows signs of weakening. However, inflation risks appear to be under control. This situation may lead the Federal Reserve to shift its focus toward supporting employment and potentially cutting interest rates. This is generally a positive development for Bitcoin. On the other hand, a larger potential lies. Tax cuts, easing regulations, and AI-driven investments could create an efficiency boom. This could protect the economy from recession and propel it into a stronger growth phase. In other words, on the macro front, an interest rate cut by the Fed could serve as a wind for Bitcoin, while a weakening economy could reduce overall risk appetite. This also carries the risk of creating an external shock that could trigger the volatility potential we see in on-chain data. Here is the chart. On one side, a structural growth opportunity brought by the integration of Bitcoin into the mainstream financial system. On the other side, tactical risks stemming from both on-market dynamics and historical cycles that require caution. Your strategy will be shaped by which of these two forces you emphasize more. Opportunities, ongoing corporate adaptation, strong demand from ETFs and DATs, healthy market structure, room for growth away from irrational exuberance, positive macro wins, possible interest rate cuts, and increased efficiency. Risks, increased volatility potential, sudden fluctuations due to high supply concentration, late-stage bull cycle, proximity to peak based on historical cycles, and the risk of correction. Weakening labor market, impact of economic slowdown on risky assets. So why does all this matter now? Because Bitcoin is at a very critical crossroads. On one hand, it is becoming an integral part of the mainstream financial system with institutional capital, while on the other hand, it faces significant risks stemming from its internal cycles and global macroeconomic uncertainties. The coming quarters will show how Bitcoin balances these two opposing forces. For investors, success will depend not only on understanding its fundamental growth potential, but also on understanding the structural volatility along the path to realizing that potential. I'm curious about your opinions on this complex chart. Which scenario do you think is more likely? Share with me in the comments. Don't forget to subscribe to my channel and like the video to not miss such in-depth analyses. Thank you for watching. Remember, these analyses are not investment advice. See you in the next video.